In recent years, financial scandals resulted in a general mistrust of financial reporting. In 2002, Congress passed the Sarbanes-Oxley Act to try to reduce unethical corporate behavior. The major provisions of SOX are shown here. A business may be organized as a sole proprietorship, partnership, or corporation. Sole proprietorship is a business owned by one person. Owner-operated businesses such as barbershops, auto repair shops, and small retail stores are often sole proprietorships. Partnership is a business owned by two or more people. Retail and service-type businesses, including professional practices such as lawyers, architects, and certified public accountants, are often organized as partnerships. Corporation is a separate legal entity owned by stockholders. Many businesses start as sole proprietorships or partnerships and eventually incorporate. The primary function of accounting is to provide financial information for decision-making. The users of financial information fall into two categories: internal users and external users. The information needs and questions of external users vary considerably. Some frequently asked questions are shown here. Financing activities. To start or expand a business, the owner or owners quite often need cash from outside sources. The two primary sources are borrowing and selling shares of stock in the corporation to shareholders. Once a company has raised money through financing activities, it will then use that money in investing activities. Investing activities involve the purchase of those resources a company needs to operate. Resources owned by a business are called assets. Once a business has the assets it needs to get started, it can begin its operations. Operating activities comprise the primary activities for which the organization is in business. Income statement reports the success or failure of the company's operations during the period of the statement. Here is an example of an income statement. Retained earnings statement reports the items that increased or decreased retained earnings during the period of the statement. Here is an example of a retained earnings statement. Assets are the resources owned by the business. Liabilities represent amounts owed to creditors. Stockholders' equity is the owner's claim on the company's assets. A balance sheet reports the company's assets, liabilities, and stockholders' equity at a point in time. The relationship among the categories on the balance sheet is referred to as the basic accounting equation. Here is an example of a balance sheet. The statement of cash flows reports cash inflows and outflows resulting from financing, investing, and operating activities during the period. Here is an example of a statement of cash flows. Because the results of some statements become inputs to other statements, the statements are interrelated. Companies traded on an organized exchange like the New York Stock Exchange or the American Stock Exchange are required to provide shareholders with an annual report which always includes financial statements. In addition, the annual report includes the following information: its ability to pay near-term obligations, ability to fund operations and expansion, and results of operations. Notes to financial statements clarify information as well as accounting policies or uncertainties. Auditor's report indicates whether the financial statements and notes comply with accounting standards.